Heya Cryptozens, it's 10 p.m. Pacific time. My name is Nikodemus, and welcome back to the Crypto Overnighter, where we take a nightly look at the crypto, NFT, and metaverse space. And keep in mind, nothing in this show should ever be considered financial advice. Hey folks, it's 10 p.m. Pacific time. The date is November 19th. Let's go. Because I don't know if you folks heard or not, but government investigators are after this guy for running a Ponzi scheme. That's right. No, I'm not talking about FTX. I'm talking about this guy, Rathnakishore Giri, 27 years old, investment manager from New Albany, Ohio. And Rath here has gotten himself into some serious trouble. He was arrested yesterday on criminal charges arising from allegations that he was running a scam worth at least $10 million. And so what this guy Giri did was he told everybody that he was this big-time crypto trader. He said that he specialized in Bitcoin derivatives. Now, according to the indictment that was handed down from the Department of Justice, he claimed that he could produce lucrative investment returns on the money that they entrusted to him. And like any good con, he claimed that it was completely risk-free. Which, damn, folks, it's current year. Who is still falling for that no risk to you fallacy? If there's no risk, it's a scam. And so, of course, what he did was the classic use money from the previous round of victims to pay for a new round of victims. So the DOJ has Giri down for 5 counts of wire fraud. Each count worth 20 years in prison if convicted. And this comes after the cease and desist letter that the Commodities Future Trading Commission sent him and his 2 companies. At the time that they were alleging he took in more than $12 million of investment funds and burned through all that flying on private jets and renting yachts. So now let's go from New Albany, Ohio to South Korea. Because even though FTX has the limelight for now, let's not forget, it was the Terra Luna Black Swan event that really kicked this crypto winter into overdrive. And what's hard for a lot of people, me included, are these crypto billionaires. They go along running their scheme. And then when they get caught, they say, oops, my bad. And then they retreat to their multi-million-dollar luxurious estates to tell us how sorry they are about how things turned out. Well, for one guy, that might all be coming to an end. I'm not talking about SBF. I'm not talking about Do Kwon. I'm talking about Shin Hai-sung. Now, Shin is co-founder at Terraform Labs. And this comes 6 months after the Terra blockchain crashed. Now, South Korean authorities have frozen over $104 million of Shin's money. They said that they did so under suspicion that they were unfair profits. This decision was handed down from Seoul's Southern District Court in response to a request from prosecutors. That said, this wasn't because the Terra blockchain crashed horribly. No, this is because of Shin's involvement in selling pre-issued Terra tokens to unsuspecting investors. So that's what they mean by unfair profits, because they were illegal, unwarranted sales, and so the court froze the allegedly stolen funds until the investigations are completed. Shin's attorney said, quote, reports that CEO Shin sold Luna at a high point and realized profits, or that he made profits through other illegal methods, are not true. And so that's why the funds were frozen, so that Shin couldn't take the money and run while he faces his investigations on making unfair profits from selling those Luna tokens, as well as allegedly he leaked customer transaction information from Chai, which is a Korean payment app linked to Terra. Now, supposedly, he leaked that information to Terraform Labs. And so it was that a few days ago, South Korean prosecutors asked Shin to show up in court as a part of their investigations into Terraform's collapse. Because it was just this month that prosecutors alleged Do Kwon manipulated the price of Luna. Terraform Labs responded via written statement. They said, quote, it's highly disappointing to see the Korean prosecutors continue to try to contort the Capital Markets Act to fit their agenda and push baseless claims. Prior judicial decisions and statements by the Korean financial authorities, including the FSC, established that cryptocurrency tokens are not investment contract securities. And through all this, we've got FINRA, the Financial Industry Regulatory Authority. They're a self-regulatory organization in the United States, and like everyone else, they're taking a look into what happened at FTX. Specifically, it seems that they're interested in the communications out of FTX regarding products and services offered by them. And so it came to pass that they announced a targeted exam on retail communications between July 1st and September 30th. So, what's considered a retail communication? According to FINRA, it's any written communication that goes out to 25 or more retail investors within a 30-day period. And by written, they're also including electronic messages such as email and newsletters. But also they're including things like video and social media and websites. In their exam notice, FINRA asked for firms to supply some additional information for each of those communications, including things like the date of the communication and whether it was filed with FINRA's Advertising Regulation Department. And still, they're asking for more. They want each of the firms to submit their written procedures for the, quote, examination, approval, record-keeping, and dissemination of each of those communications. They also want any information on any contracts with affiliates. What they're looking for is what information the affiliates had when putting together their advertisements. As far as regulations go, Grayscale investments might have a bit of a problem. That is, if on-chain proof of reserves or providing wallet addresses to show reserve assets, if that becomes a thing. Because they're refusing to do so, citing security concerns. What happened is, Grayscale put out a tweet on November 18th. And in that tweet thread, Grayscale put out information regarding how they're storing and securing their crypto assets. They also said all crypto underlying their investment products are stored on Coinbase in their custody services. But they didn't give up those wallet addresses. They said, quote, we know the preceding point in particular will be a disappointment to some, but panic sparked by others is not a good enough reason to circumvent complex security arrangements that have kept our investors' assets safe for years. Now, Grayscale is kind of swimming upstream a bit on this one, because most of the industry seems to be content to provide proof of reserves, especially given what happened to investors on FTX. And while they didn't provide any on-chain evidence, Grayscale did share out a letter signed by Coinbase's Chief Financial Officer Alicia Haas, as well as Coinbase Custody CEO Aaron Schnark. Now, this letter broke down different assets by investment products and reaffirmed that those assets are secure, that they each have their own on-chain addresses, and that they belong to the corresponding Grayscale product, that they haven't been loaned out. What they said was that each of their products are set up as separate legal entities, and they point out, quote, laws, regulations, and documents prohibit the digital assets underlying the products from being lent, borrowed, or otherwise encumbered. Now, the reason people are kind of freaking out, in addition to the general unrest of a bear market, Genesis Global is the liquidity provider for Grayscale Bitcoin Trust. Well, just a few days ago, Genesis Global halted withdrawals in face of what they called unprecedented market turmoil due to the number of withdrawals from the platform. And the FTX hits just keep on coming. Because anytime there's any kind of high-profile event, pretty much the scammers come out. Elon Musk is buying Twitter? Oh, the scammers get to work. Well, that's what's happening here. Because it seems like the $8 billion hole in FTX's balance sheet have made people scared and desperate to recover their money. Desperate people make mistakes. And that's what's behind a recent communication from the Singapore police force. They're warning their citizens to be wary of fake websites. See, websites are popping up claiming that they know how to get your money off of FTX. So what's going on is there's this website that's claiming to belong to the U.S. Department of Justice. And they're asking unsuspecting users to log into that website using their FTX username and password. Hello, people. Like I said earlier, it's current year. It's time for us to stop falling for these foolish choices. Anyway, according to a local news agency, Channel News Asia, this website claims that customers are able to withdraw their funds after paying some sort of legal fees. Now, of course, they're fooling people into giving up their FTX credentials and then fooling people to pay for the service. That said, the police are also warning citizens of fake online articles shilling crypto auto trading programs. And like the US, they attach some politician or famous person to this scam to give it the appearance of respectability. So we were talking about SBF the other night. He has new representation in the forms of a friend of a family. As it turns out, Paul Weiss, the firm that filed bankruptcy for FTX, has quit their post. They claim a conflict of interest. What sounds like what happened is they got sick of Sam's antics. Remember a few days ago when Sam in his weird tweeting, he tweeted out what happened? Remember that? Well, it seems like that was enough for the fine folks at Paul Weiss. Martin Fluenbaum is one of their attorneys. He believes that Sam's crazy tweets were disruptive in the reorganization process. He said, quote, "We informed Mr. Bankman-Fried several days ago, after the filing of the FTX bankruptcy, that conflicts have arisen that precluded us from representing him." Even so, that's not necessarily the end of it, because the judge can refuse the request. They can order them to continue to represent the client. That said, I don't see that happening. For one, you've got Sam's weird behavior disrupting the process. But two, Sam already has representation in the form of one David Mills. Now, Mills is a white-collar crime professor at Stanford, as well as friends with Sam's father, Joseph Bankman. So it's not like Paul Weiss was the only representation available to them. And finally, our ongoing accounting of the damage done by FTX's implosion continues. Here are a few more victims. A hedge fund called Galoy Capital is believed to have as much as $50 million worth of crypto stuck on FTX. New Huo Technology, owner of the exchange HBit, has $18 million of assets stuck on FTX. Nestcoin, a startup from Nigeria, said they also have money stuck on FTX, but they didn't say how much. And then you've got Metaplex Studios. They're an NFT protocol. They said that they were also laying off several members of the Metaplex Studios team because of the indirect damage of FTX. Stefan Hess is their CEO and founder, and he said, quote, "While our treasury wasn't directly impacted by the collapse of FTX and our fundamentals remain strong, the indirect impact on the market is significant and requires that we take a more conservative approach moving forward." And then there's Nickel Digital Asset Management. They announced yesterday that they have $12 million stuck on FTX's exchange. Their founder and chief investment officer is Michael Hall. He said roughly 6% of their $200 million in assets under management is stuck on FTX. And finally, this is the one that really bugged me when I first heard about it. Because when traders lose money, that sucks. It's horrible. When investors lose money, that sucks. It's horrible. But it's also part of the game, so to speak. Teachers are a different story. And when you start screwing around with people's retirements, it's not so simple, right? Well, the Ontario Teachers' Pension Plan was also hurt in the damage done by FTX's Black Swan event. They put out an announcement that they'd invested some $75 million into FTX International as well as FTX US. And while that is a lot of money, the fund released that it represented less than 0.5% of their total net assets. They actually own a substantial portion of both FTX and FTX US, 0.4% and 0.5% of whatever they're worth these days, so not much. While representatives from the funds say that they are disappointed by what happened, they said, quote, "The financial loss from this investment will have limited impact on the plan, given its size relative to our total net assets and our strong financial position." And that's going to do it for us tonight. I hope you have an awesome weekend. We'll see you tomorrow night.